Welcome to another episode of Mayhem in the Markets, brought to you by macrovisor.com, where we make macro actionable for everyone. The first chart we have here shows the weakest breadth on record for the S&P 500. Year to date, only 7 mega caps account for about 90% of the gains that we've seen so far. This is reminiscent of late 2021. We know what happened next. I'm not saying that past is prologue, but I do think some degree of caution is warranted, particularly as we're starting to see earnings for those same stocks, one of which already happened, Tesla, and it wasn't so great. Market wasn't particularly thrilled with it. The stock dropped about 9% in reaction to weaker deliveries, compression of free cash flow, and margins dropping below 20%. As we go through the next 2 weeks, we're going to have a lot of S&P companies reporting. In fact, just next week, the number of companies in the S&P reporting account for 42% of market capitalization. That includes Amazon, Microsoft, Google, Meta, and many others. That is likely to have an impact on the market one way or the other as we come out of options expiration unpinned without those supportive Vanna and charm flows to sort of bid the market up, buffer any downside. So you could say we're in a period of vulnerability where if there are exogenous event catalysts that are negative or earnings ends up being not as good as what people think they could be, that may lead to some more downside. Mike Wilson of Morgan Stanley is looking at this chart as well and saying that investors should be cautious here, particularly as we've been unable to break above this range we've had since February and really since the last 11 months. This is a range-bound market. It's likely to remain that way, and we're at the top of the range with CTAs and managed money very long. So there's not a lot of buying left, but if we do have downside catalysts, there's plenty of selling to do. Sentiment has turned more bearish in April when we look at fund managers' growth expectations combined with their positioning. I do think that this is an important chart to look at because it does tell us that people are just a little bit leery. I don't think it indicates an imminent bottom, however. I think instead it shows us that folks are not as excited about this market. The rally has been pretty big, but I don't necessarily think we're through the woods yet. We had a lot of liquidity enter the market. There was this China reopening, PBOC injected liquidity. The Bank of Japan's been more aggressively trying to control their yield curve. They injected a lot of liquidity. The Treasury General account from Granny Yellen put a lot of liquidity into the financial system. Those effects are starting to diminish a bit. And if we look at projections from JP Morgan, we're looking at more balance sheet runoff as the year goes on with the ECB, the Fed, and other central banks joining in. The Treasury General account has been run down. Tax receipts are not coming in at the level expected. So the debt ceiling debacle is coming up sooner than later, and it will be resolved. Don't get me wrong. Nobody in this government, no matter how insane they may appear, wants to see this government default. And their handlers, the corporate backers of both parties, won't let such a thing happen. So we will get a resolution to this debt ceiling. They'll extend and pretend so they can keep on spending. But when that happens, something curious will happen with the Treasury as well. They'll have to start issuing debt, and that will start pulling liquidity out of the market. It will magnify the impacts of quantitative tightening. We also see that on a relative basis, the allocation into bonds versus equities is quite high. It's the highest we've seen since the great financial crisis. But before one reads too much into this chart saying, oh, well, surely this must be a low for equities and we have plenty more upside to go, I would caution. There's several reasons why. The first is the great rotation is upon us. What does that mean? I know it sounds fancy. Maybe it's something important. Maybe it's just some silly moniker I made up. Let me explain. The great rotation is that you've got folks in their 50s, 60s, 70s, and up, and they're pulling out of equities to buy fixed income, because for the past 14, 15 years, you've had financial repression. Rates have been near zero for much of the time, and so fixed income opportunities have been limited. Now that the Fed has engaged in the most aggressive tightening policy we've seen ever, and the upper bound rate is 5%, and the terminal rate could be as high as 5.5% by June's meeting, we're starting to see people move. And why wouldn't you? If you can get a guaranteed 4 or 5% return on short-term government paper, it's kind of silly, or even just a money market account, it's kind of silly not to get some of that exposure with stocks still expensive, with earnings still on the decline, and with the economy showing signs of further weakness ahead. The other part I would look at this chart just to take it apart a little more. Consider those relative yields versus stock valuations. This could have further to go. The last time we saw this in May of 2020 and March of 2009, that was during panic. People were rushing into bonds, not because fixed income presented an opportunity as much as it was a safe haven. This time is different. This time, people are rushing into bonds because there is a large aging demographic that needs that fixed income exposure, that safety, and it's just more attractive than a lot of the equities we have available right now. Why would you want to buy the S&P 500 with a PE of 18 and up when you can get that fixed income exposure and have a guarantee of 100 cents on the dollar coming back to you? ISM manufacturing versus the percentage of companies beating earnings. The key words here being beating earnings. These expectations are set by sell-side analysts. A lot of this stuff has been revised so much lower that it's a slam dunk beat for companies, but they're beating earnings that are showing decelerating revenue, decelerating bottom line. These earnings reports are not as impressive as people may think. If you go through and look at quarter over quarter and year over year performance, if you look at free cash flow, if you look at margins, many of these companies are not doing well. A lot of their key segments are showing signs of slowing, if not negative growth. So yes, companies can beat, but ISM also suggests that earnings may start coming down even more meaningfully. Granted, manufacturing is a much smaller part of the U.S. economy than it was in the beginning of this chart, but there's still a relatively high correlation enjoyed here. And so what I think it suggests is that this earnings recession that we're experiencing is likely to continue as the economy goes through a contractionary period. I do believe we'll see a recession by the second half of this year. I believe that outcome was delayed but not canceled by some of the factors I just spoke to, the liquidity that came into the market from late last year on, combined with a desynchronized global credit cycle where you have the East, China, Japan, emerging markets pouring money into their economies as the West tries to subdue the pressure of inflation. This is a bit of a counterbalance, and it has an impact undermining the actions of the Fed and the ECB and other central banks. So that means they're likely to have to put rates a bit higher than they thought, even with bank lending conditions tightening. And it also implies that they'll have to hold them longer than the market expects. Right now, the market's looking at the first cuts around September of this year. And that's because when you look back at the last several hiking cycles, the retreat from higher rates happened almost immediately as that terminal rate was reached. What's different then and now? Well, one thing that's really quite a bit different is we didn't have inflation during those prior cycles anywhere close to what it is now. And that's a problem because expectations have been set through this muscle memory, this idea also that Powell pivoted once, in 2018, 2019, when that tightening tantrum happened. And the reality is he's not going to make the same mistake again. And back then, things were a lot different. We had low inflation in a very weak economy. Now we have a somewhat more resilient economy, at least on the surface. If we look at the labor market, if we look at the headline GDP numbers, it appears a little more resilient. Inflation's meaningfully higher, significantly above the Fed's target of 2%. I think they've still got a ways to go in terms of how long they're going to hold rates where they are. probably through sometime in 2024. I don't believe there will be any cuts this year unless the Fed really breaks something big. We'll have to see what happens in the second half of this year. 87% of the S&P 500's market capitalization will have reported earnings by May 5th. Next week, 42%. The week after, 24%. So we are in peak earnings season in terms of the impact it might have on the S&P 500. And next week is the key. Now, I won't discount the week after because on May 4th, Apple reports, and of course, we also have the Fed on May 3rd. So these next 2 weeks are going to be really important. And this compression of realized and implied volatility is likely over. The VIX, as low as it is, I think we've got some room for volatility to rise in both realized and implied terms. Speaking of volatility, how funny is it that we now have a one-day VIX? I'd love to hear people's thoughts about that in the comments. I was actually working on building the math behind this for my own indicator, but CBOE apparently read my mind and said, we'll do that for you. Hey, be my guest. You guys have all the data anyway. So we're going to have a one-day VIX soon because these 0 DTE options actually account for close to 50% of daily volume in the SPX index options, which are the center of the options universe. Banks hold over half of the overall stock of commercial real estate loans, and small banks own the vast majority of those same loans. This is kind of a big deal because those same smaller banks, they're not doing so well. We've seen the stresses of deposits fleeing, asset liability mismatches where they hold a lot of duration that they can't sell for par. They're down 20, 30, 40% on some of these. And on the other side of it, they've got loan books that are under increasing stress. One of those areas is office space, commercial real estate. Another is retail is starting to become a bit more of an issue, but I think there's a lot more to go there. Industrials and even leisure may become issues, and I'll be watching multifamily units as well. Basically, volumes in all of these areas and sales have dropped. Issuance of debt has dropped. This credit situation, the tightening has been very fast since what happened in March with Silicon Valley Bank, with some of the other banks starting to show some stress as well. I don't think we're through the problems that we've seen, but I think we're in sort of the eye of the storm right now. The Fed has bought some time, and this is exactly what Powell wanted to do. A lot of folks misinterpreted this as quantitative easing, as if the Fed just injected $300 billion into capital markets in the midst of this unprecedented inflation that we've experienced over the last several years. That's not the case. The Fed created what's called a discount window facility. It's like a super discount window facility. They're lending with a 1-year term at 4.5 to 4.75%. Now ask yourself a question. If you're going to the Fed and you're giving them a piece of collateral and it yields you, say, let's say 3%, right? And you get this loan at 4.5%, you've got a negative 1.5% carry cost. So you're going to try to get out of that loan. This is not liquidity you're going to put into the NASDAQ or you're going to start speculating with. This is not juicing up the markets the same way people may think. What really happened was bond volatility came down, and there's an inverse correlation between the MOVE index and the S&P 500. That's to say, when the waters are calmer in the bond market, equities get a little bit of stimulation. But to call this and conflate it with QE, it's not the same thing at all. And it doesn't even matter at this point. It's a moot point because the Fed's balance sheet is shrinking again. That's right. QT is still going at a run rate of up to $95 billion a month, 60 billion of which is treasuries that are rolling off and 35 billion of which mortgage-backed securities. This process is going to continue, as is tightening and keeping rates higher, because the Fed assuaged some of the concerns in the banking system. They provided this facility, and that gives them the opportunity to keep rates high. That's the real truth behind it. That facility was probably spun up months ago. I'd have to guess January or February. Remember when Powell came out and I talked about how nervous he was on that February meeting that something was wrong? I think he saw some of this coming, and the Fed had been talking about some of the concerns they had with the banking system going back to the December meeting, and specifically talked about commercial real estate and small and medium-sized banks in the February meeting. They saw it coming. And Powell kind of celebrated it in March, saying, you know what, this is going to do some of our work for us. Bank tightening is going to do some of the contraction of overall available credit, slowing demand, and we're seeing some of those effects. Look at what we saw with retail sales. Look at mortgage applications falling. Look at small and medium-sized credit falling. A lot of these areas are showing us signs, and there's never been this amount of credit tightening without a recession before. And I know I keep using the ugly R word. Oh, Mayhem, why are you such a bear? Why do you keep talking about recession? I hear it all the time. I've been in this game since 2005. I didn't start in 2020 like a lot of the folks that like to criticize me, who have never seen a real recession or a real bear market and think it's just up and away with everything, that valuations and macro don't matter. And I could understand how people might believe that. But the reality is that these things do matter. And the ephemeral effects of some of that liquidity that hit the markets from October on is beginning to wash away. I think it's very important to take fundamentals and macros seriously. Yes, technical analysis is great, and I use it too. But there's more than just lines on charts in terms of what's happening in this market. Another thing I frequently hear that I'm just going to momentarily rant about is that every bit of data that we can possibly see about the economy and companies is backward looking. And therefore, it's no longer relevant, and the market is always pricing in the future. And it's always forward looking. Well, how many bear market rallies accurately price the future? Was it the one in March last year? Did that accurately price the future? The idea that a Fed pivot was imminent? It did not. How about the bear market rally we had in summer up to the September lows? Did that price the Fed pivot accurately? Did that price the Fed and the economy and earnings and everything accurately when it came down to those September, October lows? I don't think so. And what's up with the fact that markets keep pricing things in perpetually? Because there's a whole lot of different variables at work, and there's a lot of emotion, and there's a lot of presumption. Price is very important to watch. Don't get me wrong, we have to follow price. But to look at it in a vacuum and assume that is the end-all be-all of everything, I just think that's a little bit too two-dimensional. I think it's really important to have more nuance. And I'll be honest with you, some of the folks that actually not only focus on price, but they actually start criticizing people who even talk about macro or talk about fundamentals and have a realistic view on these things, that tells me they just don't want to take the time to understand these things. I'm just being brutally honest here, and the reason I'm doing that is I'm trying to raise awareness about what could happen. And I don't think it's going to be good. And people say, oh, but you're a perma bear and you're so, negative. I was extremely bullish for a lot of 2021 until we got to about October, November. I started to get much more concerned. In January 4th of 2022, I put out a video on this same YouTube that called pretty much the exact top on the market on the day when the Fed started getting very serious about QT. I'm not a perma bear. Like I said, I've been around in this game for 18 years. And I wouldn't say this stuff to mislead anyone. I'm saying it because I am actually concerned. I'm a long-term investor. I have long-term portfolios too. I have a retirement account. I have a taxable investing account. I don't want the market to go down to zero. But what I do want to see is some degree of reality set in. Because if a new bull market was to start from the levels we had in October or even now, it'd be the most expensive valuation for a new bull market in the history of the stock market. Is that what we want? A short bull market that sets us up for a brutal decline? Because that's what you're asking for if you're saying the worst is behind us. I just don't think that's true. And I think a lot of the folks that are getting very, very sort of confrontational and all bulled up and just won't hear any other side of this, they're going to get hurt. I don't want you, if you're watching this, to be one of those people. I want you to just take into consideration what I'm saying. None of this is trading or investing advice. It's meant to be informational, educational content. Open your mind to the world of possibilities that maybe the people that are out there that just started in this game over the last couple of years have no idea what they're talking about. The labor market is responding to tighter lending conditions. This is a theme that we just talked about. The tighter lending conditions are having an impact on commercial real estate. They're having an impact on small and medium-sized businesses, the consumer, even state and local governments, and eventually the federal government will be impacted by these rising interest rates, right? Where they'll be paying over $1 trillion in interest. So there's this convergence of, if you're lucky enough to get a loan, it's going to cost a lot more. That's going to have an impact on labor, because small businesses are the largest creator of new jobs in this country. Well, what happens when people start losing their jobs? They're not going to consume as much, are they? This is a consumption-driven economy. The math here is not complicated. The inevitable conclusion of this has been forestalled by some of the things I talked about. It has not been canceled. And as much as I don't want us to go through a recession, because I don't want to see anyone lose their jobs, I don't want to see, people lose their retirements or, have to come out of retirement so that they can get back in the workforce to rebuild it. I'm not looking for that to happen, but I am pragmatically realistic about what is very likely to happen. And I don't think it's going to be good. So this content, it's meant to be a wake-up call. It's not meant to scare you or anyone else. It's not meant to create this idea that we're just going to be in a permanent bear market and we're all going to die and everything's going to zero. No, because in real bear markets, some of the best opportunities we'll ever see in our lifetime are born. And believe me, when I feel we're getting closer to that point, I am going to be pounding the table about talking about the opportunities on the other side. And that'll be the point where everyone out there will call me crazy again. Oh, look at Mayhem. He's bullish when the world is ending. And I'll say, yeah, that's one of the reasons why. Because when everything looks like it's at its worst, that's when some of the best opportunities are going to come about. That's not right now, by the way. And that wasn't October of last year. And if you really look closely at what I've been doing, October of last year, when we had that CPI day, I was getting pretty bulled up because I was saying, you know what? This market is extremely offsides to the short side. We had sellers ridiculously short by every metric. The sentiment readings were extremely low. And that CPI day reversal we had, where it was like a 5% inside day range, that was one of the most insane days I've ever day traded. I made a lot of money that day. And it was a lot of fun trading it. It was an extreme adrenaline rush. And that was a marker of an interim bottom. I even got on a Twitter Spaces not too long after that and talked about what I was seeing. I'm not a perma bear. I'm not a perma bull. I'm not a perma anything. I am someone who has been in the market for a while. I like to try to be as objective as I can and share my analysis. And what I'm putting out there doesn't necessarily reflect my positioning in that moment. I'm sharing information from a larger time scale. So one of the things I notice is people are like, oh, well, the market's not going down on that in like 5 minutes of the data being released. Yeah, it probably isn't. Because it takes time for that stuff to be processed, for it to have weight. And this goes back to the conversation about macro and fundamentals being backward looking. Look, when data starts to form a trend, those trends have impacts that can shape future price discovery, whether it's in individual stocks, industries, sectors, or the broader market or whole asset classes. Okay? So when we start to talk about that, what does that translate to? Being an observer of macro fundamentals and technicals, as well as the broader psychology of the market, is important. That, combined with some level of nuance and objectivity, allows us to gain a better level of insight than simply just looking at one of these things in isolation. And I will put it from a different perspective because I don't want to bag on just technical traders. I know plenty of amazing technical traders. So this is not meant to offend anyone. But if you go out and you look at some of the fund managers and all they do is bottoms up fundamentals, they're blind too a lot of the times. I have some mentors that are amazing fundamental investors on the value side, on the growth side. They've done very well for themselves. These guys could retire tomorrow if they wanted to. But you know what? They got their butts kicked in 2022. Why? Because they were blind to the macro. Because they were blind to the technicals. These guys got killed. Doesn't mean they couldn't retire. They're still really rich, but their funds got killed. Why? Because they ignored the other dimensions of the market. This is why it pays to be open-minded, but also to be a student. Never stop learning. If I can imbue upon you, my listeners, who I appreciate all of you very much, if I can imbue on you one idea, it is never stop learning. Please. Because that is where you develop an edge. And the market never stops changing. So as soon as we become complacent with one idea or one strategy or one technique, that's where you get yourself in trouble. So consider this. Anyone who's too focused on one area that doesn't look at the bigger picture is missing what all is happening. And I know people love to make fun of macro folks saying, oh, macro has no purpose. Tell that to Stan Druckenmiller, please. Go ahead, be my guest. Because I'm sure that the people that say that are more successful than he is. Or say it to Ray Dalio, a full cycle investor and trader. Built the biggest hedge fund on earth. Pretty sure he appreciates macro. And I know a lot of people don't like George Soros, and I'm not saying I'm a huge fan, but the guy made a lot of money on macro too, including breaking the Bank of England. There is value for everything. But if you start to take these different disciplines and put them together, that's where the real money is at. And that's also where the ability to sate a hungry mind is at. So if your mind has a big appetite, which it should if you want to be successful at this game over the long run, then you'll never want to stop learning. End of rant. I hope you enjoyed that. The US dollar supposedly has begun its fourth bear market in the past 50 years, according to Bank of America. I don't believe this is true, but I find the chart to be quite interesting. It suggests that that gold is going to go higher, that the euro is going to go higher. Euro long positioning is very, very extended. So is gold long positioning. I think both of them have run their course. The dollar on a relative basis is enjoying higher rates than the European Union, higher rates than Japan. Those are the two biggest pairs against the dollar index, right? So that basis alone kind of tells us, okay, maybe some of that weakness in the dollar will abate. We know the Fed is talking about hiking at least once or twice more. That's likely to give the dollar a little bit of a push higher. But so is the idea of a recession coming ahead. And this could be a situation where both the gold and the dollar rally together in that recessionary environment. So I would, again, keep an open mind. The dollar may not be done what it's doing. And until it breaks below 100.50 on DXY, I don't think the uptrend is over in the intermediate term. And unless, if you look at the really long-term chart, if you take that trend line back to 2011, because we've basically been in an uptrend since then, it tells you that this is still a bull market in dollars. I know a lot of folks are out there saying, oh, the dollar is going to die. China and Russia made a bilateral trade agreement or a trilateral trade agreement. There's all these other countries, Brazil and China, Kenya and China, they're doing business in their own currencies. That's great and all, but this sort of stuff has been going on for 25, 30 years. It's a slow process. The dollar is not going to die overnight. It will die over a course of decades. And I know some of that's already happened, but there's plenty more to go. So don't look at the situation through the lens of imminent peril and start making rash decisions. This inflation that we've seen, it has been scary for a lot of people to see their purchasing power get eroded so much. But what has gold done during this period of unprecedented inflation? It's barely performed. In fact, gold right now is barely above levels it was during its 2011 peak. We have to go back 12 years. And we're not much higher. So much for it being such a great protection against inflation. It's not. It's not. You can look at the charts yourself and then think about how much the dollar's purchasing power has been devalued during that same period of time. And then think about how many new dollars have been created, how much the global supply of dollars has grown since then, particularly after COVID. The dollar has stayed relatively stable during that period of time, and gold has been an absolute roller coaster. That doesn't mean gold doesn't have a place in one's portfolio, but I think it's important to realize what that place is. Gold is not so much a hedge against inflation anymore. Not in dollar terms. Other currencies, that's a different story. But in dollar terms, what gold is, it's a hedge against uncertainty. That's the role it plays as a portfolio diversifier. So I think the dollar has some more room to go. I would be surprised if the bull market in dollars is over. I don't think it's going to be over until we see a recession and we're starting to see the light on the other side of that. And here's a chart to help me make that point, to drive it home. The euro long positioning is extremely long. This is lopsided long. I think we're pretty much max long euros here. That doesn't mean that the euro has to go down a lot, but I don't think it has much more room to rise. And this is just more context for my idea about what's happening with the dollar. We have room to run higher, particularly as rates may continue to move higher. And traders are raising bets on a Fed rate hike in June, fully pricing in a 1/4 point. Now, I'm more in the it could happen camp than it will happen camp. I think that the Fed is still very data dependent, but I think that this is what's going to push them over the edge. When we get April's CPI data in mid-May, and then we get PCE in late May, and April's likely to be hot because we saw commodity prices, particularly led by energy, really rally pretty significantly during this month, at least so far. That's likely to pull inflation higher. And that's likely to have a deleterious impact on the Fed's policy goals, which means they're likely to at least want to do one more hike and then sit back and pause and kind of wait and see on rates. They're still going to run off their balance sheet. QT is the elephant in the room that people continue not to talk enough about. But 95 billion or about that much running off their balance sheet every month, that is a big deal. And that is having a tangible impact, particularly as during this same period of time, we're going to see the Treasury come back and start issuing rather than spending into bank reserves. They're actually going to be starting to pull liquidity out of the system with that new debt issuance. And there's a whole lot to catch up on because they've been on pause. The Bank of America Fund Manager Survey, investors expect the Fed to start easing the first quarter of 2024. That may be a little early. The next highest level of votes is the fourth quarter of 2023. Again, I think that might be a little bit early, but we'll see. This is all dependent on when the Fed breaks something, because I don't think we're going to see 2% PCE, their favorite flavor of inflation, anytime too soon. I would be very careful being too aggressive pricing in a Fed pivot. And here's the other thing. And this is just going out to all the folks that think a Fed pivot means the printing press is on and we're back to all-time highs immediately. The Fed pivots not because everything is great. They pivot because something is meaningfully broken in the economy and or financial system. That's not a good thing. And typically, it takes about 10 months from the first rate cut before we see a bottom in the market. Let that resonate. And these are statistics that go back about 150 years. Copper prices recover as stockpiles shrink. Now, this is not an idea for the near term, but a longer term investment opportunity as we get into the next economic cycle is definitely copper. Whether it's the commodity, the companies that produce it, some of the intermediaries, I think that eventually this is going to be a great opportunity because exploration is very low, production is very low. We've seen problems with some of the leading copper producers. They are not producing commensurate with what we've seen prior. And exploration is not allowing them to have that reserve available for them to start pulling more out of the ground. So I would be very concerned about where we are when we get to the next credit cycle, when we start to see growth. Because there are some drivers for that demand, particularly electronic vehicles, which take almost 150 pounds of copper per vehicle. And then you start to consider, well, what if we start doing some construction? What if we start seeing some more solar and wind and other kinds of power generation coming online? That's all going to be big drivers of copper. And, we call copper Dr. Copper because it's kind of a measure of economic health. It's a barometer of demand for a key industrial metal. I would be keeping a very close eye on the price of copper throughout this cycle and the next. And we get to that next cycle, I think copper is going to be a great opportunity, and some of the better run miners in that space could be excellent opportunities as well. So I want to thank you for tuning in to this edition of Mayhem in the Markets. I hope you enjoyed it. I know I went off on my tangent. I got on my little soapbox, but I think it's important that we all take a moment to sort of step back out of our own mind state of focusing on any one area of the market and be open. Be open to looking at technicals, to fundamentals, to macro, to psychology. Also open to looking at different asset classes. We don't have to just trade stocks or options on stocks or futures of equities. There's a whole world out there in commodities, in currencies, in bonds, and also in other regional equity markets. An open mind is a happy mind. So I'll leave you with that thought. And once again, I want to thank you for tuning in. Really appreciate everyone's support. If you enjoy this content, please share it with your friends, share it with your colleagues. Be sure to subscribe, like this content on YouTube and otherwise where you find it. And check out macrovisor.com where you can find more research like this. We also have a 50% off discount for the first year. So if you sign up right now for our monthly or yearly plan on Macrovisor, you will get 50% off for your first year until May 1st. Also, check out TraderAid.com. We've got a 10-day free trial on our base plan and 20% off using the coupon Mayhem20 on me. The difference between the two, as you're probably thinking right now, Macrovisor is all about intermediate to long term. It's a top-down, macro-driven approach. It's academic but accessible. We make macro actionable for everyone. TraderAid is about day trading to short to intermediate term swing trading. It's much more technically driven. So these are differentiated services. They can complement each other if you're interested in all those time frames, but check them out. Macrovisor has free content on the website. TraderAid has a free trial, so you get a little bit of a sample of what we're doing. I hope you'll consider looking at that, and then follow me on Twitter if you enjoy this content. Mayhem4Markets, that's Mayhem number 4 Markets. And I will catch you next time, wishing you a great week ahead.